All right, good morning, everybody. Thank you so much for attending our class today. So this is Redland Type and Diamond Residential Mortgage Corporations. So today we're going to go over the one of our non-QM products, the 12 months and 24 months profit and loss statement program. So this is just another type of, I guess, alternative solution to the non-QM, to the traditional loan program. So we like to, but basically, not everybody fits into it, the same box. That traditional lenders, I guess, have wanting us to fit into, right? So basically, the last since the 2010 or so, after the crash, the mortgage industry came up with additional requirements for borrowers, and since then, obviously, they came up with a lot more kind of restrictive requirements in terms of the your traditional loan requirements. But Diamond Residential has been working all from in the last couple of years to really try to find solutions to help borrowers who are not able to qualify for the traditional loan products and be able to still be able to borrow a home loan. And this is just a little comparisons, among like we think three branches of of lenders or banks. So you have your traditional banks, right? Your Chase and B of A and Wells Fargo. They focus mainly on savings and checking account. They also offer, obviously, conventional loan products such as your Fannie Mae, Freddie Mac type of loan, but they tend to be more, I guess, limited in terms of their product range or product line. And most of them, as far as we know, they don't offer non-QM products. And then you also have the second type of lenders are the Rocket Mortgage, guarantee rate, lending tree type of online and type of lenders. And these are lenders who tend to be, offered to their program through mainly online, right? You don't have physical offices where you could go to and apply for a loan or see talk to a loan officer. And they tend to offer loan products to we call it B plus and better borrowers. And most of their non-QM product, they do offer non-QM products, though not as much as other lenders, but they do a lot of time they broker these non-QM products to investors. And they do come with their own overlays or additional requirements than the investors guidelines. And then you have, like lender like Diamond Residential. Our main goal is to obviously work with real estate agents and professionals in the real estate community, and we offer multiple sources of different type of product, I guess, products, mortgage products, and we have a dedicated really department to that offers that help us with our non-QM product, and we try to really offer a lot of alternative type of loan programs for the customers who are not able to qualify for your traditional loan. And usually we don't add, I should say most of the time we don't add like overlays or additional requirements to the program, whatever program we offer as a lender. So we follow the investors guidelines, so we don't usually offer any additional requirement or overlays on top of those investors guidelines. So as I indicated earlier, in the last couple of years, DRMC or Diamond Residential has been one of the leaders in really promoting flexible and creative solutions for borrowers who are not able to qualify for a loan under traditional guidelines. Again, traditional or agency guidelines are your guidelines. You follow guidelines from Fannie Mae, Freddie Mac, or your VA, FHA, USDA type of loan. Those are called the agency guidelines or the traditional guidelines. And so the new type of loan products we came up with are the alternative loan programs, or usually known as non-QM mortgage. So what is a non-QM mortgage or a loan? Non-QM is a loan designed to help, again, homeowners or home buyers, borrowers who cannot meet the criteria of qualified mortgage or traditional products. So these are called non-QM, basically, products. What non-QM is not? So it's not a stated type of income. I guess many of you may have heard about stated income may be offered by maybe certain lenders. Basically, you just make up your income and put that on your applications. So non-QM product is not that. And it's not a predatory or subprime type of loan that we saw, before the 2010. And non-QM product is not negative amortization. So usually we offer fixed rate non-QM product. Even although we do offer certain products that feature interest only and also fixed payment. And non-QM products are not are not really super high in terms of rates. I mean, certainly they're not as high as hard money loans. And I like to think of the rates for non-QMs are really between your hard money loans and conventional loans. Tend to be just a little higher than conventional loans, not really anywhere close to the hard money loans. And there's usually no prepayment penalty for, well, I should say no, we don't have any product off that requires prepayment penalty on primary loan. So prepayment penalty usually only applies to investment properties for our non-QM product. And we don't really have a very high, since the non-QM products have really come out only in the past couple of years, maybe 5 to 7 years. So we have not seen any problem with default rate, in terms of any default on these products. So this is like a list of the non-QM products that Diamond offers. We actually offer a couple more other products, but these are the main ones that we usually work with. Your bank statement loan, investment property type of loan, the SDR program that we already did classes on. And then we also did class on ITIN borrowers in the last couple of months. And today we're going to go over the 12 and 24 months profit and loss statement for loan program. So I think we as real estate professionals and loan officers, we have seen a lot of obviously borrowers who are self-employed and who have run into a problem qualifying for mortgage loans. because of the guidelines, because of conventional loan guidelines, right? There are certain ways that we underwrite conventional loans that really, in a way, are not really beneficial to self-employed borrowers. And there are various reasons, why self-employed borrowers are not able to qualify for a mortgage loan under the traditional guidelines. And here are the some of the reasons. So a lot of times, as a self-employed individual, right, you file your Schedule C. Let's say you are a self-employed individual, with no corporations, LLC, stuff like that. So you file your tax return and your Schedule C, and of course, you as a self-employed individual, you do have a lot of expenses. So unfortunately, by the end of, once you have calculated all your income and your expenses, your net income might not look as good as we would like to see, in order to help you qualify for a loan under the traditional guidelines. So for that reason, a lot of times we see that's the issue with self-employed individual. And then even if you have, like, let's say an S corp or LLC, and the way you maybe report your income on your Schedule K or might not be acceptable to the underwriter, following the traditional guidelines. And also there are a lot of times as self-employed individuals, small business borrowers, you do have different interests in maybe or I should say you have a lot of ownership maybe in different business entities, and then it depends how you file your tax return. That could give us an issue with income to qualify for the loan. And the other thing is that we see quite often is where maybe somebody has worked as a as a W-2 employee, right, for many years. They earn quite a bit of money. Maybe they have good income working as an employee, and then recently, let's say just a year ago, they started their own business, right? And unfortunately, in that situation, we would have to go with their business income, not the income from their previous, I guess, job. So, and as we discussed above, I mean, a lot of times when we look at a self-employed type of business tax return, we see, a lot of deductions, stuff like that, and in that situation, that individual wouldn't be able to qualify for a loan. So this is where I guess DRMC could be a hero to these self-employed individuals. I mean, with DRMC's or Diamond's profit and loss statement loan, we could potentially help these borrowers who are not able to qualify under traditional guidelines to qualify for a mortgage loan. So rather than using a tax return, we under the program, we will allow them to use a profit and loss statement prepared by a CPA or a tax preparer like an EA. And like, as we mentioned before, for primary home and second home, under the profit and loss statement, there's no prepayment penalty. And the loan, and basically if they're able to purchase a home under the program of the profit and loss statement, they will be able to refinance the loan when they are able to qualify for a traditional loan program, maybe in the next year, 2 years from now, when they're able to show more income for the traditional loan program. But obviously this is a way to get around that, right? The restrictions under the traditional guidelines. So for obviously for real estate agents, you know, this program could be really a way to create more business for you, right? I mean, you know, you don't have to turn away anybody who's self-employed, obviously. You know, don't just assume they don't have a way to qualify for mortgage just because, you know, maybe they show you their tax return and it doesn't look really good. But maybe, you know, when we actually analyze their you know, their income and stuff like that, we might be able to help them, you know, qualify for a loan under the profit and loss statements. So the main thing is just make sure we have a chance to review the information the borrower or the prospective buyer, you know, provides to you. So what is a profit and loss statement? I guess this, you know, they basically, again, it's a designed specifically for self-employed borrowers and who are not able to, you know, basically qualify for a loan. And obviously, you know, you know, we wouldn't need your traditional documentation such as pay stuff like that, or 1099 and W2, what that the traditional loan products require. And like the bank statement loan program, which we previously, you know, had a class on, the profit and loss statement program really provides us with an alternative way to help these self-employed individuals qualify for home loan. So how does it work? So again, the borrower needs to be self-employed, basically, and we don't need, again, we don't need tax returns for the program, and the program could be used for purchase, internal refinance if it makes sense, and also it could be used to cash out like an existing you know, home. So let's say if the borrower needs it, I mean, matter of fact, I did like a cash out not too long ago for somebody who wants to cash out on an investment property, and it's use the cash out proceeds as a down payment on a new purchase. So that could be done using this program. And the other thing is, you know, basically we just need documentations regarding the self-employed status of the borrower. And the other thing is we just need the basically a profit and loss, either 12-month, 24-month profit and loss statement prepared by an accountant who could be a CPA or could be an enroll agent or EA. And the difference between between the 12 months and 24 months are the rate. Basically, you know, what if you provide 24-month profit and loss statement, you usually get a quarter or 0.375 better rate than a 12 month. Just like a bank statement loan where we do we have the 12 months or 24 months bank statement loan program. So this works the same way, and the difference is, again, it just comes down to the rate. So the general requirements for the profit and loss is again, you gotta be able to prove that you are it's a business, a self-employed individual, and you need to also show proof that you have been in business for at least 12 months. And again, you need to provide, you know, your information on your business ownership also. So we need to know what your whether you own the business 100% or 50%, 25%, you know, etc. So we allocate the income accordingly, based on the percentage of your ownership.
Rala,
Yes.
hard question. You say that somebody has working for somebody, getting good money, and then suddenly he wants to open his own business,
Right.
which is that right there. So in the transition between working, maybe still working with this company, whatever, and he's opening his own business, you say you have to use the business, not the salary that he has here.
Yeah, because remember the profit and loss statement program is
Yeah, but I have a question. So we're talking about maybe in the process, maybe he hasn't been 12 months,
right.
so he cannot apply for this loan.
Right, exactly, because it needs a minimum 4 months.
So he
Because
cannot be using his income right here.
not from his W-2 income under the program. But I mean, good question. So the profit and loss basically must reasonably reflect the income and expenses of the industry described. Otherwise the underwriter might require additional verifications or explanation. So it's, obviously, since this is a profit and loss statement program, so what the underwriter will focus on are the numbers on the profit and loss statements, right? So, and they are obviously they go by industry. I mean, there are information, or actually there is, information out there that provides, the underwriter with an understanding of what's the average, profit profit percentage of each type of industry. So again, they kind of, you cannot, for example, you cannot say that maybe you are, working in a certain type of business and your income is outrageously high. I mean, they're able to find information to help them kind of analyze the business, the profit and loss statements. So it's, I mean, if it makes sense, obviously, then they would accept the numbers on the profit and loss. If not, then they might ask you to provide additional information. And again, the CPA or the EA who prepared the profit and loss statement must sign, date, and attest to the accuracy of the statement. So that's of course, because the underwriter relies on the information shown on the profit and loss statement. So they need the CPA or the EA who prepared the profit and loss statement to sign it, acknowledge it, and also again attest to the accuracy of the statement. And of course, we would also ask the CPA or the EA to provide information to show that they are licensed and certified and they're properly, there's no, I mean, they're current, their status is current and stuff like that. This is just an example of somebody I used before. Basically, in this case, I guess the person is a real estate agent. Of course, I changed the information, but again, that was the information provided by their tax preparer, right? Obviously, since we don't look at their tax return, don't look at their other tax information, so we rely on the information provided on the profit and loss statements, and it shows the very high net income for these individuals, and he was basically, in this case, he was just trying to doing a cash out refinance, and with a net profit of 353,000, he had no problem qualifying for the cash out refinance loan.
So that's all you're using?
Very simple, yes. I mean, basically, the format is quite simple. Obviously, it depends on the type of industry. You know, you might have
Yeah,
the information so it might change a little bit,
Right.
but yeah, but basically, you look at the gross receipts and
Mm,
or gross, income and you subtract the
yeah.
expenses. Yeah, very simple.
Hey, question.
Mhm.
Most of the time, when you're dealing with self-employed, let's use a plumber, that he can be his own company, blah, blah, blah.
Right.
He in income taxes might show maybe the same amount of money roughly every year.
Mhm.
But when you're talking about a real estate agent, the profits and loss are high and low. This year can be really, really high, but the next year can be not low, but an average difference. So
Right, right.
you only use 1 year or you?
So that's where the 24 months might come in handy.
Yeah, but that's 2 years. So in 2 years, one might show high, the other might low.
Right, so we average out. So because we add up we add up all the income, right, for the last 24 months, and then we subtract the expenses for the last 24 months and then divide it by the net profit is divided by 12. So that's how we come up with a monthly income. So if your previous year, maybe you had a lot more month, right, income. And then well, I should say maybe 2020 you had a lot more, 2021 a little less. And then, your average might bring up your monthly enough to qualify.
Yeah, but when you say qualify, it's gonna be based on what I wanna pay. Let's say, as a real estate, say, I wanna stay on like $3,000 a month. Maybe you will not qualify with the numbers that you have there, right? Or is that, am I wrong?
Well, let's say okay. So, let's say your average, 24 months income, like, 10,000, right? And what you say, you just want to pay like $3,000 a month?
Well, yeah, let's say I'm on.
Then that's how we usually a 50% debt to income ratio. So if your monthly payment, you just want a monthly payment of 3,000 on your PITI, your principal, interest, tax, and insurance, stuff like that. As long as your other monthly debts don't exceed 2,000, then your total debt is less than 50% of your 10,000 income, then you can qualify. That's how the way the debt to income ratio, we use the same calculation to qualify as a conventional. Yeah. So yeah, I mean, as you can see, it's again quite simple. You don't need expert to prepare the profit and loss statement. So with this program, so here are some of the highlights. So with the profit and loss statement, you could actually borrow up to $4 million. I mean, the loan amount could be as high as $4 million. The only thing is, the higher you go up, the loan to value is going to be slightly lower. So with a $4 million loan, your loan to value is probably 65%. So that means your $4 million dollar loan cannot be more than 65% of your home value. And you could borrow up to 90% of purchase price. Again, let's say you want to buy like $1 million home, and you could borrow up to $900,000. And there's no PMI, there's no mortgage insurance, even if you put less than like 10% down. And FICO scores could be as low as 600. But of course, you're not going to be able to qualify for a $4 million loan with 600 FICO scores. You need like at least a 720 for 700 to 720 for a higher loan. And as we mentioned, there's no prepayment penalty on primary home and second home. So we missed that one. So but with investment property, we do give you the options of having no prepayment also, but then you will have to go with a higher rate. So usually on these products, your prepayment penalty terms range from 0 to 5 years. So obviously, if you're willing to go with the longer prepayment terms, and you would get the best interest rate. And the property could be, up to 20 acres in terms of the lot size, but it cannot be in a rural or agriculture area. So that this program doesn't you wouldn't be able to qualify using this program. And anytime the lot is 10 or higher, in terms of the acreage, then you're limited to 80% loan to value. And with this program, just like a lot of our non-QM products, we do offer a 40-year term. And this 40-year term is combined with the fixed kind of, the 40 term is combined with like an interest-only feature. So usually how that works is, you could, if you go with a 40-year term, basically the first 10 years could be just interest only, and then after that, the next 30 years would have to be amortized. The payment would have to be amortized, principal interest. And gift funds for down payments and closing costs could be up to 95% for primary home and 90% for investment property. What that means is, so for a primary home, the borrower would have to come up with 5%, at least 5% for their down payments and closing costs. And on an investment property, the borrower would have to come up with at least 10% for down payment and closing costs. So and the rest could be, the rest could be objects, which is again, the gift also applies to even investment property. So you're on a conventional loan program, you wouldn't be able to use gift if you purchase an investment property. That's only allowed on primary home and second home. So again, these are the highlights, and it's the programs is actually quite flexible, and they could be actually very beneficial to a lot of the self-employed borrowers out there, or maybe prospective borrowers or home buyers or homeowners, because they could use the program for rate and term refinance or cash out refinance, and on top of a purchase situation. So yeah, together we can get it done. We would love to work with all of you. I mean, again, don't hesitate to come to us with any scenario. We have not, obviously we don't, again, we don't provide, a lot of time we don't have the opportunity to give you all the details, all the, regarding what program we offer, stuff like that, or the specific details about each program. So you might not know, a lot of your maybe prospective customer, could qualify for some type of loan. So never turn them away, and never, try to diagnose the situation by yourself. Try to at least give a chance to talk to them first. And again, that's it. That's the our loan profit and loss statement program. Profit and loss, statement for self-employed individuals. So yeah, so thanks. Let me check I don't see any chat, any questions. Okay, does anybody have any questions? I think Gasway got his question answered.
How long can you normally take to go from 0 to funding? Like, what is 30 days enough? Does 17 days contingency work for loan and appraisal?
So we could probably push it to maybe about 21, 25 days.
For loan and appraisal contingencies?
Oh, well, for loan, we could actually do probably yeah, maybe. I don't want to overpromise.
With the
But
17 days
But for 17 days on your, yeah.
on the
Yeah,
contract?
the contract
Okay.
is no problem. I mean, obviously, as soon as we open escrow, we did make sure we order the appraisal right away
Okay,
and collect all the information. Right
Okay.
from yeah, so, yeah, so if we need to push the loan to get it closed, we'll
Okay.
make it happen. So we do have a dedicated, non-QM department
okay,
who help us with all these programs, aside from your traditional conventional loan programs. So, but anyways, if there are no questions, then I want to say thank you for attending, everybody, and again, our office is just right in front of the elevator on the second floor, right next to Ruben's office. If anybody needs to stop by and ask questions, feel free. But if you don't see us in the office, sometimes we might not be in the office due to various reasons. Feel free to reach out to us. You have our information right here. So the Ruben will provide a copy of the slides to everybody, I guess, who are interested in getting a copy, and you have all of our information right here. And usually it's Brenda and myself who will be in the office. Patricia is here on Thursday, and Petra is part-time. But if you know her and if you would like to work with her, feel free to reach out to her too. Okay, so again, thank you so much, everybody, for attending, and have a wonderful day. Thank you.